Last January, a penthouse at Bugatti Residences in Dubai sold for $150 million. $150 million for a single apartment. The buyer didn't blink. 3 months later, the Dubai Financial Market Real Estate Index collapsed 30% in under 2 weeks. 2 years of gains gone faster than you can wire a deposit. And the people holding off-plan contracts right now, they're not calling their brokers for updates. They're calling their lawyers. This is the story nobody in Dubai's government wants trending. The story of how the most aggressively marketed real estate market on the planet went from breaking its own records to breaking its own investors in the span of a single quarter. And the twist? This time, the threat didn't come from the market itself. It came from the sky. Let's rewind, because the setup matters. By 2025, Dubai's real estate machine was operating at a level that made even its most vocal critics go quiet. In 2025, real estate transactions in the emirate reached nearly 917 billion AED, roughly $250 billion, the highest in Dubai's entire history. More than 270,000 deals were closed. Residential deals alone accounted for around 200,000 transactions. Since 2021, housing prices across Dubai had risen between 60 and 75%. Read that again, 60 to 75% in 4 years. And it wasn't just statistics. A 47,200 square foot penthouse at Bugatti Residences set a price record for Dubai and the entire UAE when it sold for 550 million UAE dirhams, approximately $150 million. The narrative was airtight. Dubai wasn't just a market, it was a movement. Golden visas, zero income tax, the world's most connected airport, billionaires relocating from London, Singapore, Mumbai, and New York, all pointing in the same direction, all saying the same thing: get in now, or get left behind. Off-plan transactions made up 65% of Dubai's deals in 2025, and by January 2026, that figure had climbed to over 71% of all activity, when the market was still recording its highest-ever monthly transaction value of 72.4 billion AED. That was the mountaintop. Now, here's where it cracks. Before a single missile was fired, the warnings were already there, buried in the footnotes of analyst reports that nobody wanted to read at the peak of a bull market. According to Fitch Ratings, a moderate correction in Dubai property prices was expected to begin in the second half of 2025. The anticipated pullback, pegged at no more than 15%, was being viewed as a natural adjustment after a surge of nearly 60% in residential prices from 2022 to early 2025. The reason? Supply, catastrophic, almost comedic oversupply. Approximately 250,000 units were slated for delivery between 2023 and 2026, with a peak of 120,000 units expected in 2026 alone, projected to outpace the city's population growth, forecasted at around 5% annually. And here is the number that should have stopped every investor cold. According to UBS estimates, Dubai could see over 110,500 new residential units delivered in 2026, far exceeding the 10-year average of just 27,000 units per year, 4 times the historical average in 1 year. The developer model feeding this frenzy works like clockwork in a rising market. Collect deposits, build fast, sell the rest, at a profit, repeat. But what nobody said out loud was that this model has a name when the market turns. It's called a liquidity trap, and in early 2026, the trap was already set. Then came the event no financial model had priced in. The trigger was swift and brutal. The United States and Israel launched missile strikes on Iran. Iran's supreme leader was killed. Tehran responded by targeting Israel, U.S. military bases, and Gulf states, including the UAE, Saudi Arabia, Qatar, Kuwait, and Bahrain. In 48 hours, Dubai went from the world's safest luxury real estate bet to a market sitting inside an active geopolitical conflict zone. The Dubai Financial Market Real Estate Index plunged 30% from the moment the conflict started, erasing every gain made in 2025. Now here is where most media gets the story wrong. The 30% index collapse was not a 30% drop in your villa's value. It was a crash in developer equities. Emaar, Nakheel, the listed builders. But don't let that distinction comfort you, because what followed the stock market shock was something much quieter and much more dangerous. In the first half of March alone, property transactions in the Emirate fell to about 6,129 units, down from around 8,199 in the preceding two-week period, a roughly 25% decline in volume driven by rising geopolitical risk and buyer hesitation. And the reason for that hesitation? Thousands of flights were canceled or rerouted due to the conflict. Property viewings declined significantly, since many high-value transactions depend on in-person visits and site inspections. The slowdown in air travel translated directly into delayed and canceled deals. Think about that for a moment. Dubai's entire off-plan sales machine, the engine that was moving 71% of all transactions, runs on international buyers flying in, touring showrooms, signing contracts. Ground that air traffic and the machine seizes. But here is the layer that the headline writers keep missing. The geopolitical shock didn't cause this crisis. It accelerated one that was already forming underneath. Between the first and third quarters of 2025, median prices had already slipped almost 11%, from 1.65 million AED to 1.47 million AED. Analysts at Knight Frank said Dubai was approaching a turning point, not a crash, but the top of the growth curve. Areas like Jumeirah Village Circle, one of Dubai's busiest transaction districts, are projected to see prices flattening or correcting outright, given that around 35,000 homes are expected to be delivered there alone over the coming years, roughly 10% of the Emirates' entire future supply. And the investors now stuck holding multiple off-plan units at peak pricing? One Goldman Sachs trader, speaking off the record, said people are being wiped out. Senior rates traders in London confirmed colleagues were in a panic over off-plan properties that are now, in their words, unsellable. These are not retail investors who got caught up in social media hype. These are professional traders who ran the numbers, believed the thesis, and still got burned. So where does that leave us right now, in April 2026? The honest answer is it depends on which Dubai you're invested in. As of mid-March 2026, Dubai real estate prices had not crashed. The stock index had. The Dubai Land Department's transaction registry told a different story. 87% of Dubai property purchases in 2025 were cash transactions, removing the mortgage leverage risk that triggered the 2008 collapse. Rental yields of 6 to 9% remain among the highest of any major global city. Prime waterfront assets, Palm Jumeirah, branded residences by Tier 1 developers, these are holding. The buyers in those segments are cash-rich sovereign wealth funds and ultra-high net worth individuals who don't need to sell and aren't panicking. But step outside those postcodes and the picture is completely different. Mid-market and investor-driven off-plan projects are where the pressure is most acute. Projects in outer communities, high-density apartment towers, and anything relying heavily on speculative overseas demand are experiencing sharp slowdowns in inquiries and longer sales cycles. Analysts warn that current price corrections of around 4 to 5% could deepen further if geopolitical conditions persist. In a prolonged conflict scenario, continued travel disruptions, cautious investor sentiment, and rising construction costs could extend the slowdown significantly. And here is the part that should concern every person who bought into the dream at peak pricing. Not the billionaires, but the software engineers from Bangalore, the entrepreneurs from Cairo, the families from Karachi, who stretched their savings because an influencer told them Dubai yields were guaranteed.